Thanks, Matt, and good morning, everyone. And don't forget to send in any questions that you may have. We can respond to them throughout, and then again, we will open it up for questions at the end. So what I wanted to touch on here was target date funds and their equity exposure at retirement and beyond. And I think that one thing that we have seen, given both Tom, Jeff, and Matt's presentations today, is that equity funds do experience different performance and different flows. So what I did was we released a report in 2008 that looked at equity exposure. So what I was able to do is to create a case study where we can compare 2011 equity exposure with 2008 equity exposure. So that's what I'm going to do here. So here we can take a look at what's happened to assets since 2008. What we can see is that assets have doubled over the last 3 years in target date series. And this is interesting because in 2008 we witnessed the economic downturn, and 2010 target date funds were only 2 years from retirement at that point. Those funds witnessed significant losses, and in 2010, when those target date funds reached their maturity point, their 10-year annualized returns were similar to that of fixed income funds, so they were less than 5%. This table also shows the top 3 series assets, and as you can see, they're the same. The top 3 series are the same in 2008 and through 2011. So really 2 things have happened since 2008 that make this 2008 versus 2011 a great case study. The first is the economic downturn and the low performance of the funds near their retirement date. The second is that the SEC proposed rule changes for target date funds. And the SEC is really proposing that target date funds provide greater disclosure surrounding their glide path in their prospectus. And that's what we're going to focus on here. So what I was able to do then was to compare the 2008 and 2011 prospectuses. And we really looked at 2 things: language changes and equity exposure changes. So just to talk briefly about the language changes, we have seen that there is more disclosure about expectations at retirement. So fund companies are really starting to explain, how much withdrawal is expected by the investor at retirement. And this varies among fund companies. Some fund companies say, we expect the investor to withdraw all or most of their funds at the retirement date, where other fund companies just expect investors to begin to withdraw funds at the retirement date. A second language change that we've seen is that we've seen more warnings that target date funds do not guarantee any sort of returns at the retirement date. Now, despite this, there does seem to be a consensus among investors that they still have this notion that they do guarantee funds. But I would say that comparing the language in the 2008 versus 2011 prospectuses, fund companies are trying to be as upfront and as obvious about this as possible. Now, beyond the language changes, what we did was to look at equity exposure at the retirement date. And we can see from these 2 charts here that there is a decrease in the overall equity exposure, but it was small. It was only 3%, from an average of 43% to an average of 40%. And we can see that the mode, so where most fund companies are, has remained the same at 50%. Now, if we take a look at the highs and lows, that tells us a little bit more of an interesting story. We can see that the high changed from 65% equity exposure at the retirement date to 55% equity exposure at the retirement date. This was a result of there was 2 or 3 complexes that had that 65% equity exposure, and they have decreased their equity exposure. And then on the low end, we saw new target date series coming in, and they came in at those lower numbers. And that's what created this small shift in the average equity exposure from 43% to 40%. So the next thing we wanted to really look at was to versus through target date series. And first, let's talk a little bit about what I mean and why this is important. So through target date funds, what we're looking at here is an example of a through target date glide path. And we can see that at the red line is the retirement date. And we can see that the equity exposure here continues to adjust past the retirement date. And for this particular fund, we can see that it continues to adjust for the next 25 years and then stays flat after that. And this can range depending on the target date series, can range from 5 to 35 years, this continuation of the adjustment. Two target date funds, on the other hand, stop adjusting their glide path at the retirement date, or they automatically move the funds from that target date fund into the retirement income offering. So what we wanted to do was to look and say, okay, there seems to be two different types of target date series in the industry. Does that have any implications for equity exposure at the retirement date? And what we found was, yes, this does seem to have an implication for equity exposure at the retirement date. On average, through target date funds have considerably higher equity exposure than two target date funds, 45% versus 31%. Their highs are similar, and the actual low is in the through target date series, but that doesn't affect the fact that their average is considerably higher. So that really wraps up my portion of the presentation, and now I'd like to open it up again for questions, or if anybody else has anything else to add.